Hello, everyone, and welcome back to another segment produced by Tushaus Wealth Management. My name is Blair Tushaus. I'm out here in Scottsdale, Arizona. Have another office out there in San Diego, California. Right now, we're experiencing some great weather. Let's keep it up before it gets a little too hot. Anyways, before I dive in today, I do recommend anyone watching this video, please take note of our last video. It's about cash inefficiencies, especially in your taxable accounts. Go take a look at that video, and we'll have some other videos coming up here and how they all connect really as part of a proper planning for your retirement. Today, we'll be talking about long-term care. There's a lot of things to discuss about long-term care that a lot of people aren't talking about. So we're going to dive into some of the stats. We're going to dive into what does that mean for you in your next 20, 30, 40 years, and how do we prepare for that? Because right now, this is a topic nobody's really discussing, and it needs to be discussed about because this is one of the big icebergs of your retirement that could sink the Titanic of your nest egg. So let's dive in and let's first talk about what are the issues. And so this morning I was just kind of Googling, hey, what does Google say long-term care? And you can see I typed it in there. I didn't want to give it any good or bad bias and just see what are some of the discussion points, and some of these caught my eye more than others, but Ohio's population ages, so people are living longer, which is going to cost somebody hundreds of thousands and millions and probably billions of dollars more. The next line, lawmakers revive efforts. So just without reading these articles, I'm thinking, what's the balance of is our government going to be paying for some of these long-term care? We have Medicare, but we're going to talk about how much does that really cover these long-term care events later in life? And who's going to foot that bill? I mean, let's just think about it here for a second. Our government is over 30 some trillion dollars in debt. And by the looks of it, it's not going down. But do they want another thing on their plate to pay for? And if not, if you're like me, and I would say probably not, who's going to pay for that bill? So, as the American population gets older and older, these costs increase, and it's probably going to be left to the American people to pay for those long term care events. Some of the other ones, just talking about state funding. The last one, long-term care, housing cost rises with somebody who's had grandparents go through that type. I've seen as somebody, needs more and more specific care, like memory care. The cost of that and the cost of that type of housing can significantly increase. And so, for my specific situation, it was over 13 years ago, and back then the costs were over 13,000 a month. So, anyways, the main issues here are longevity, people living longer and longer. I kind of relate this back to Social Security. When Social Security first came out, it was designed when people were really only living into their mid late 60s. Those were the averages. Our government wasn't prepared to pay out Social Security for longer periods of time, decades. I know we're talking about long-term care here, but as people are getting older, this is going to be more expensive for longer. The cost of insurance. Insurance, companies are not out here to just give away money. There is a give and take. It is they use actuarial tables to determine a cost depending on the whole society. And they try to factor in what somebody's costs to insure them for so many years on so much amount of money. It's a lot, there's a lot that goes into it, but we'll break it down later. Medicare, we talked about Social Security, Medicare. Where do these government aids come into place? How does Medicare factor into helping some of these costs, if at all? And then long-term care policies, where were they 30 years, ago, 2000-ish? Wow, it's been 26 years since 2000. That's crazy to think. 1995 to 20 2005 was the height of long-term care policy. So what happened to them? Why are they decreasing? And how does the underwriting work? It's a give and take there, but we'll dive into that. And then just the overall financial impact, especially to you. What's going to be your bill? And how does that look like? How can you solve for it without putting a big dent in your wallet or being even rejected by underwriting? Or the worst case scenario is when we have clients come in is I don't want my kids to feel like I'm a burden to them because once funds run out, that's typically the next step to go. So how do we avoid being that burden? So let's dive in. Longevity. Longevity is just a good and a bad thing, right? People are living longer. We're just making so many medical advances. And I really wanted to get an idea based on, Social Security and CDC tables here. What is the life expectancy, especially gender specific, male versus female? So let's dive into some of the stats. If somebody lives to 60 years old as a man, we can expect that person to live another 22 to 24 years of age, bringing them around 82, 84. Okay, I just mentioned the Social Security back when it was put out. People were averaging in the 60s. Now it's much further. Now this is for somebody who makes it to 60. We can expect them to live another 22 to 24 years for a male. Now for females, it's even longer, 25, 27 years, bringing them to age 85, 87. Why is this a big deal? Well, when we build our nest egg over the years of working, maybe you have a 401k plan, maybe you have a trust, maybe both, there's pensions, there's a lot of different sources of income and assets that we're building up over time. 10, 20, 30 years ago, when people weren't living as long, well, it's a shorter time horizon to make those assets last longer. Now, people in our field as financial advisors planning, we have to plan for a much longer duration, especially in terms of higher inflation or a lot of number of different factors, higher taxes, a lot of different complexities that we have to deal with that we weren't dealing with 30 years ago. And 30 years ago was 1996. It went by pretty fast, right? So, some other stats 70% of Americans age 65 and older will need some form of long term care, assisted living, or supportive care later in life. 70%. That is the clear majority. So, yes, there will be 30% that do not need anything. But how do you know? Who has the crystal ball? A lot of people could look back and say, well, my mother lived to 90 or my dad did this. And, that can be helpful. But really, are you going to gamble on saying, you know what, I won't need any type of assistance? That's up to you. But really, 70% is an alarming number that we need to take attention to. 20% will need it more than 5 years. Why do I think that's an important stat? 5 years is a long time. And when we get into the cost of long term care, I want you to think back to that 20% because 5 years is going to be a lot of money. And it's a lot of money in today's dollars, but it's especially a lot of money in future dollars when we factor in for inflation. So women on average need some type of assistance for 3.7 years. That's a good amount of time. And then men, 2.2 years. So we know women live longer, and we know women will need that type of care for longer. So that's going to be very costly. And men, we're statistically not going to live as longer, but we also don't want to leave our significant other in a bad spot where they're put with a bigger bill for longer and we depleted the assets. What do we do? So let's dive into it. The cost of long-term care now. This is 2026. Okay, so if we're 65 today, what's gonna be the average cost? And I put the two locations. We're primarily based out of Arizona and California because the national averages, depending on certain states, could be much lower. It could be much, much higher. I have home health aid to assisted living to nursing home. On the left there, the duration, as we mentioned, 2.2 years for men, 3.7 years for women, and then just the total cost over those 2.2 or 3.7 years. Assisted living could be 168,000 for men, 283 for women in Arizona, 194,000 for men in California, 327 for women in California. So really these aren't small numbers, people. This is something that if this isn't catching your eye a little bit, then maybe you're in a great spot. Doesn't mean we can't be more efficient with our assets or trying to solve for these, even if we had 10 million, which we do have clients who come in and they're way above and they could be self-insured. Doesn't mean we can't take advantage of some of the things that they're offering today to solve for some of these big, big bills. So the reason why I capitalize it now is because for people retiring right now, they're not paying for long-term care now. They're paying for long-term care in 20, 25, 30 years from now. So let's look at the costs of long-term care then. Okay, so this is just 20 years. Just imagine 25 or 30, trying to be conservative, and we use a 5% inflation for healthcare costs and long-term care costs. Some periods of time we've seen this more than 5%, and some periods of time it's been less. We try to use 5% just to be clear across the board and look at what happens to that those numbers. I just go to assisted living somewhere in the middle for men, Arizona 538, California 620, assisted living for women 726, 820 in California. As these are big numbers, and we need to plan for those big numbers accordingly. A nursing home, and there's even more subcategories in this. I mentioned memory care that can be astronomically more, but I just didn't have enough space on the slide, and I just want to make this easy for your viewing pleasure. We can see that these numbers, so women, 3.7 years, in California, over 1.13 million. That is mind blowing. So there are things we can do today to help solve for that. But let's get into some other things first. Well, Blair, what about Medicare? Medicare should cover some of that, right? I paid into it. I have this great policy. There's got to be, part something that cares for it. Well, let's just break down the parts. Well, part A is hospital care. Part B is medical insurance. That's where you get your co-pays and things like that, x-rays, doctor visits, right? Part C is a little bit weird. Part C is actually Part A and B offered through Medicare Advantage. It's kind of the private offering of Parts A and B. But they do offer some vision, dental, hearing, things like that. I'm not going to get super into Medicare. That's a whole, hour conversation. And then Part D is prescription drug coverage. So, what are we not seeing? Medicare doesn't cover long-term care. They're not going to cover facilities, memory loss, in-home health. They're not going to foot this bill. So either, the government has to create another meta something, or guess what? You, the 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 person receiving that type of long-term care is going to have to front that bill. And that's what the government is planning for. So now let's break down long-term care insurance policies. I'm talking about the traditional policies where we pay premiums, monthly or annual premiums over time to have some type of um, daily benefit if we ever needed this type of care. These type of long-term care policies normally involve some type of underwriting. Underwriting is a way for the insurance company to see how healthy you are. They may run some blood work. They may look at your physician notes and see how healthy you are. And depending on your health, then you're going to get certain scoring, and that will actually determine how costly your monthly premium is into this policy. After all, these companies are not going to hand away free benefits. They need to make sure that their premium matches the benefit that they're going to provide. At the end of the day, they can certainly just reject you. And look at the first stat. As few as 4% of Americans age 50 or older have long-term care policies. Blows my mind. That is unbelievable. But that being said, I don't blame them. Okay. There's a lot of things wrong with these traditional long-term care policies that 4% used to be higher and is slowly going down. More than half of all long-term care policies were written between 1995 and 2005. So there was 8 million policies in 2000, now down to 5.8. The US population is only expanding since then, and yet the policies have condensed, which just says there's something wrong with these policies, right? They're not working, something's not right, and really why? So let's answer why. Why are these policies not existing anymore? Well, many of the insurers exited that long-term care market because it wasn't profitable, right? It's not a good, they're not making money. They honestly have to charge ridiculous amount of premiums to pay for hundreds of thousands of dollars over, several years. It just wasn't a good model for them. So we're seeing these companies just say, no, thank you. You're going to have to self-insure, right? And for a lot of people, that may not be possible. So premiums increased dramatically for those who stayed in the marketplace. I put male and female here for a lifetime coverage of $500,000, which we showed, in 20 years from now could cover most, if not all of it. Some scenarios, not all of it, but male 65, different policies depending on your underwriting status. And do we have any type of inflation protection, meaning the coverage grows over time? You can see 60 or 4,500 to 7,000 with no inflation protection, or 6,000 to 10,000. This is per year inflation protected. And then female 6,500 to 10,000, no inflation protection, 8,000, 12,000 with inflation protected. So really, gosh, whether you have the inflation protection or not, just to have the decent amount of coverage, 500,000 20 years from now, you're going to be paying a lot into that. And really, what's the opportunity cost? If not paying into this premium, a lot of people are thinking maybe I just put that money elsewhere. Or what if I don't even need the coverage? I think that's one of the biggest questions asked. I just paid, let's just take a male at 6,000, 6,000 for 20, 25 years. And then what if you don't need it? Well, that premium was just wasted. It's not like it went into some type of death benefit or something you could pass along to your spouse or to your kids. this traditional long-term care coverage, that premium sat in the pocket of the insurance companies and therefore um, did not go to your family once you are deceased. So that is quite unfortunate. And then just over time, we saw a lot of lapses exceed new sales. Once again, it just was not a good market to be in. So a lot of these insurance companies said, either I'm just going to raise premiums so high, or we're just gonna slowly leave that market. And then underwriting restrictions, of course, they got um, more and more strict on who they allowed to have a policy. Even the slightest, somebody with atrial fibrillation, or my wife works at Mayo Clinic, and the amount of people with the slightest heart, have different intricacies and things wrong, it's just a big red flag for these companies. And, they'll just say, hey, you pay this high premium or we're going to reject you. Or they may just reject you from the beginning. So quite unfortunate that, there's quite a few people that couldn't even get it, even if they wanted it. So we need to find the solution for wasted premium, as we just discussed. So after 20, 25 years, if we didn't need the long-term care, what if we had that pool of money in something that was growing efficiently with principal protection, and could be given to our spouse or given to our beneficiaries? That's the first thing to solve for. Second thing, expensive costs of insurance. Okay, premiums were expensive, but also the cost of insurance in these policies, they had a lot of other fees, M&E fees, administrative fees. It all adds up. It got costly, and ultimately, we need to find ways to eliminate that quote unquote cost of insurance, cost of, if something had a death benefit. That's where we would see a lot of those costs of insurances show up. And then the underwriting liability. Oh, I have this precomposed or predisposed heart defect, or I have, diabetes, or we need to find a solution, an investment that doesn't strike you down just for something that is of health concern. So something that we just separate the health liability factor. And what if I don't need it? It's kind of one of those, we don't have a crystal ball. You could be part of the 30% that does not need long-term care. We don't know that. We don't have a crystal ball, but what if you don't? Could it be used for something else? Okay, so could we utilize this solution for anything else? And so now let's dive into something that we call evolve. And we are evolving the solution for long-term care. We're solving for long-term care in a totally different component than other people are thinking. Okay, so I have a lot of things I want to go through here, but I have this little evolve pinwheel here. And really, what I showed on the last slide is what we're solving for. We're going to show you something with no underwriting, no ongoing premiums, and no fees. Okay, so once again, there's no underwriting, no ongoing premiums, and no cost of insurance, no fees. So, what does this look like? This sounds complex. This is difficult. Change is difficult. But in order to solve something this complex, we really need to evolutionize the way we think about long-term care and solving for it. So I put some bullet points, and we're going to slowly go through one by one, but we're going to position this solution in a structured solution. So what do I mean by a structured solution? It means that what we put into it has full principal protection. Okay, so there is something we're going to be putting, a principal amount a one-time premium into this solution. But this solution will have a full principal protection, meaning there is no market risk to this solution. It is fully protected and cannot go down. But this solution has crediting on the upside of the market. In this next slide, we're going to go through how that looks like, because ultimately, this fourth bullet point, this is an investment first and a long-term care solution secondly. Okay, so an investment first, long-term care if we need it. Because if we don't, guess what? It's an investment that has an actual cash value. So let's take a look at how the investment works first, then we'll come back to the long-term care. Investment first. Okay, on the left here, I'm going to show 4 made-up returns because the market has what we call market volatility. And I exaggerated this, but really what we're showing is 4 years of market return. Somewhere it goes down, somewhere it goes up. And we're going to compare it to our Evolve investment solution. So let's put $100 as a demonstration into the market. If we got 100% gain, we doubled our money to 200. If we lost 50%, we lost 100 on the 200, so down to 100. Doubled it again, 200, down 50, back to 100. So really, I'm not trying to show a specific return. I'm just trying to show that the market has volatility. And in some of our investments, especially those we need for a long-term solution, like long-term care, we can't afford that volatility. We need steady growth. And so what Evolve does, if you look over to the right, it actually has returns based on the market, but none of the downside. So here are the rules of Evolve. It gets half of the market return, but the years the market goes down, it results in a 0% gain. Okay, so year one, we saw 100% gain. In Evolve, we only get 50%. Okay, so the $100 is 150, not the 200 that the market had. But if the market went down like we saw in year two, you get a 0% gain. In the market, you went back down to 100, Evolve, you're sticking at 150. So you're really going up the stair step. And then in year two, the market doubles. We get half of whatever the market gets. So 150 goes to 225. And then ultimately, we stay right there because the market went down the next year. Okay. We did see some very volatile times in the market, especially during the dot-com bubble to the Great Recession. 2000 and 2013, I would encourage anyone to go look at a chart of the market between those 13 years. It's a big roller coaster. And what we really emphasize is that during retirement, do we want to ride that roller coaster, hoping that our money, grows? Like, what if we need long-term care during those 13 years and the market's down 30, 40%? Now we're paying significantly more for long-term care, or we have to find a different solution. So the reason why Evolve is an investment first is because we need to have something grow that actually has a cash value and can solve for that wasted premium. But we need it to also be conservative in the fact that we can't expose our principal to losses, because after all, this is set aside for something much greater. We know that's going to be expensive for long-term care. So this is how the investment side works. At the end of the day, I want to be very clear. If we don't need these funds for long-term care, it can be utilized just like any other one of your investments. So once again, don't need long-term care? Great. We have an investment that appreciated over time, tax deferred, and we could utilize on that. But now let's go back to, wait a minute, what are we solving for? Long-term care. Great. We have an investment. There's no more wasted premiums. There's no fees. There's no underwriting But now we're in the situation where we need long-term care. Okay, so let's talk about that. Well, this type of policy, and I put actually one of our clients' actual figures here. We invested 155,000 for her, and by the age of 91, this policy has a separate component to it where it guarantees long-term care benefits, and it grows exponentially faster than the actual investment itself. And we calculated that by age 91, she would have $339,000 per year for 5 years. Okay, so remember the average that a female would need 3.7 years? Well, this would pay out $339,415 for 5 years. That is a significant payout and benefit for somebody investing only 155,000. Blair, how'd you get 155,000? We do initial planning work and reverse engineering to exactly the dollar amount, how much she needed by this age to get this benefit because we factored in inflation, an exact amount how much she would need by age 91 to pay for those type of long-term care expenses. But let's say she got to 91 and she passed away, or she got to 91 and she didn't need long term care. That's where this bucket comes in. She actually had a cash value, a death benefit, and that's synonymous. It's of $587,214 that she could take and utilize for whatever she needed. This is significant. Remember, we talked about the cost of long-term care facilities being, 500 to upwards of $1 million in 20, 25, 30 years. If she grew at a conservative investment, right, she would have, that 587. Well, remember, if she depleted that money, and we're playing in the world of it was just in an investment, then where does she go to next? When you're self-insured, when you're out of money, you're out of money. But with a policy like this, it keeps paying year after year, even if you deplete your actual investment. Okay, so that 339 in her example, we chose to get paid out of 5 years. And if she needed it for a 6 year, they will continue to pay and it'd be half the amount. So it'd be around $160,000, $170,000. But this would be paid out continually, no matter how long she lived, even if she depleted her whole cash value. She has that money guaranteed by this company, all while she did not go through any underwriting, no ongoing premiums, no fees. All she did was invest, according to our planning work, 155,000 today, which would produce the necessary amount of long-term care at age 91 and gave her a cash balance that if she didn't need it, no harm, no foul. So once again, there's a lot of problems when it comes to the traditional long-term care. There's the underwriting, there's the wasted premiums, there's the fees. Today, we're talking about evolving that and solving for something that, frankly, not a lot of people are solving for. If this is something of interest to you, I highly encourage you to reach out to us. Our information is below, and please click to schedule a strategy session. In there, we can talk about the things you may need, not just, hey, is it 155 or is it 200 or is it 50? What is it for you that's going to solve for your long-term care? And it could be you and your significant other, but we want to make sure that this isn't a surprise 20, 25, 30 years down the road. Okay, so once again, I encourage you to reach out, have that discussion, and figure out how you can implement something like Evolve in your retirement portfolio. Okay, once we solve for something like that, you'll feel more at ease. You'll feel relaxed knowing that you can go through the next 20 to 30 years in retirement, not thinking about this big bill later in life that you have to pay for. Okay, so once again, I thank you for joining us, and I appreciate it from Arizona and San Diego. We appreciate all those who listen, and we look forward to having that meeting with you sometime soon.